Hello and welcome to the fifth episode of the Property Development Club. I'm John Kenel and this is Andrew Crosby, and we've got a lot to talk about today.
Yeah, sure have. Look, there's only one thing on this. It's like the world blew up yesterday afternoon at 2 o'clock, didn't it? And you go to LinkedIn and everyone, including myself and you, dropped some posts about it. But the Reserve Bank, is there anything else to talk about?
Well, it's a big about face, really, isn't it? We're not going to cut, we're not going to cut, we're not going to cut, and then they cut. So they didn't really have any choice, though. I think there was something, I read something that about 70% of punters were expecting a cut. That's how high the odds were. We all know that the New Zealand economy is toast at the moment, so they have to do something about it.
Yeah, and they don't flag things very well. The previous meeting, no change. The one before that could still go up. And we all knew there was a 1.8% in September of last year thing, moving through that was about to drop off. So I don't know. Is it optimistic for the property market, or is the economy about to go worse, or what?
No, I think things will pick up. I think it's a really important signal that had to be made that we're now moving into a lower rate environment, and I think it'll make a big difference. Just that signal, really, that hey, we're cutting, and there are further cuts to come. There's a piece here from John Caron at Jarden. He said that in cutting official rates by 0.25, the Reserve Bank executed a 180-degree turn from its hawkish stance just 3 months ago. A deciding factor for the OCR cut was that excess capacity is growing by more than expected, which is seen as pushing inflation down further than they thought. So he thinks the Reserve Bank need to follow up with OCR cuts in subsequent meetings to stabilise the New Zealand economy and put a lid on rising job losses. He's expecting a 4% OCR in 12 months' time.
What does that mean for mortgage rates?
Just on that 180-degree turn, I'll just show you this. I thought it was quite funny. Here we go. So there's no U-turn. The Reserve Bank governor hits back over rate cut flip-flop. So John Caron was right. He said it's an 180-degree turn on what the bank said 3 months ago. And old Orr over here is saying, no, that's not a flip-flop. We always planned that. So pretty funny.
Pretty funny, and it will be a stimulus to the property market one way or another, especially once we get through some of the locations that have some excess stock. Interesting things. I'm fascinated by real estate psychology and how you sell stuff. And if you want to list your home, do you wait now because you think the market's going to go up and you wait till summer, or some agents are saying you get in now? What do you think? What's your experience on that?
If you want to sell,
yeah,
I'd probably be hanging on.
Yeah, I'd be. Interest rates hit 4, right? 4 point something.
Well, exactly. I think this is, if we're not at the bottom of the market, then we've got to be somewhere close to it. I would have thought. I think we've got to be past the bottom. Listings are up 33% on a year ago, and interest rates are at highs or near their highs. Property prices, you'd think, must be somewhere near as low as they're going to go. And now that they've signalled, the Reserve Bank signalled this cut, then things will start turning around. In fact, if I'll jump back over and share my screen again. Tony Alexander here is talking about house prices rising before the end of the year. So he's pretty bullish. He's not saying there's going to be a big jump up, but the reductions are over. So he talks in this article about the 33% increase in listings. Job security is still pretty poor. Young first home buyers and renters are leaving the country still, right? So people who are, smart, motivated, got get up and go, they're getting up and going. I think that's one of the reasons that we've seen the softness in rents recently, and also, a reduction in first home buyers because they're bugging out. But that's all happened, that's all baked in. That's all in the price now. So, like you just asked, would you sell your home today? Well, you'd have to think twice, wouldn't you? Or or you put your price up a little bit, asking price up a bit, you know?
Yeah, I would. I think I'd be holding off. I mean, it looks, interest rates. It's on a one-way. Famous last words. It's on a one-way trajectory now.
Well,
Immigration is also on a one-way trajectory. Unfortunately, it just hopefully it doesn't go down too far.
Well, I was looking through at the different banks and what their predictions are. So I just said that Jardins talked about rates being at 4%, OCR at 4% in 12 months. Kiwi Bank is the most bullish. They're talking about they're thinking a 25 cut for every meeting from here right into 26. So they're predicting 2.5% OCR by the end of next year. ASB's at 3.25. John Bolton at Squirrel is at 3.9. The Reserve Bank is talking 4. So on average, we're talking about 3.3% mortgage rate by the end of next year, which would equate to a sort of a 5.5% mortgage from about 7 today. So that would make a big difference on if you owed $500,000, which, okay, granted, not a lot of homeowners, but I'm thinking more of property developers. $500,000 of debt isn't much for us. That's $150 a week. That makes a difference.
Well, I remember back in 2019, I was doing my sums on a worst case of 5% interest rates, which obviously got blown out of the water on investment property. But yeah, it's looking like we'll be there this time next year. Hopefully not too much carnage along the way on that. Look, other news.
Hopefully.
We can get back to that, but everyone's going to be talking about this. Other news. I mean, there's a whole lot of news about house. If you read the data, house prices are going up, down, sideways, not doing anything. So let's just wait a bit on the market news for a couple of weeks and see what impetus this thing has. I mean, the banks were sort of predicting it, but it just shows that they were still surprised because of how fast they dropped the rate immediately after the announcement. Maybe that was because of the tone on further cuts coming later on. Anyway, in development news around the traps, look, good on them, Auckland. They've launched another project, Station M in Meadowbank, sort of a brick apartment project in a reasonably affluent suburb, and they're getting on with it. It's got pretty high prices and everything else, but they're into it. So that's good on them. They're predicting the future a little bit. There's an article here from Vincent.
Nice looking.
Oh yeah, that one there. Yeah,
nice looking development.
Brick and black. Can't beat that really. In many cases.
Is there really farmland around that?
Yeah, because it's close to the Araki Basin, and there's a little bit of fields and paddocks and stuff around there. It's a good spot.
Okay, cool. Are we getting some kind of commission on this? That's right. And then Vincent Capital, they've told everyone in the world that they've secured $300 million facility with Goldman Sachs for new development projects. So they're hunting for deals. More money than deals. Probably, it's always the case, isn't it? Yeah.
Dwelling consents, they've gone down. That was expected, and builders are having a tough life, and everything else in that regards. Look, KO's officially stopped, John. It's all over, Rover. It's specific projects have basically been they're calling it put on hold in some instances, but Chris Bishop has been very clear. You can't build more than you're replacing, and so for development projects, that means nothing more than the current pipeline that's under, that is funded. Okay. And once again, I think I mentioned that before, they're building in a clip of 4,000 per annum this year. That drops to about 2,000 next year and about 500 the following year. So if you're in the building industry, building stuff, and your client's KO, you're pivoting right now because it's about to dry up significantly. Really? Unfortunately for the industry, because this is probably the time when the government should pump money into more social housing. And I guess they will through community housing providers. But I'm just getting an inkling they're not 100% sure what to do, because I just got an email from the Housing and Urban Development Department of MB, and they've basically sent an RFI out to the New Zealand industry saying, if you've got any bright ideas for financing social housing providers, such as the community housing providers, let us know. So they're asking for institutional investors to find innovative ways of funding new social housing, which
Okay.
says to me that the government have closed up their books and they're trying to get the private sector in.
Right.
And they control ACC and New Zealand Super Fund, which possibly should be doing this anyway, depending on your political persuasion. So very interesting in that regards. And
For
look,
sure.
we can get into it a little bit, I guess. There's an announcement in Auckland on development contributions. Hamilton's had their one, and the Hut has had theirs, and there's some big rises projected for out west and for Nuapai and different locations, Mangere, etc. The parts that council have got good information on, and I've been told 100 grand a unit, John, up from 20 odd.
Oh,
20
that's
odd to
ridiculous.
100.
That's ridiculous.
A terrace might go from 17, 18 to 60, 70. Anyway, that's the news on that side of things.
What was the news the other day about some change they're making to footpaths? That footpaths are going to have to be a lot wider. What was that all about? Is this another thing that council have dreamed up to try and make it harder to build houses?
Look, and I'm sorry to the listeners who are not in Auckland, because it's obviously top of my mind of what's happening in Auckland, and
it starts at Auckland and then it filters down, doesn't it? Generally.
So a relatively well-known architect commented on a post of mine, and he sums it up correctly. He says, Auckland Transporter planners now.
Okay.
So what they've basically done is they've said, all these developments you've done, these little 7, 8, 9, 10 unit developments, basically your bread and butter, John, the people are doing those in Auckland.
Yeah.
You need to have a 1.8 metre wide footpath. God knows why.
1.8. That's a very wide footpath.
It's you lying down. That's an extreme.
Yeah.
And but if it's adjoining a carriageway or a driveway, it has to be only 1.4, and it can't be part of the carriageway. And it's just basically what it does is rear sites now are undevelopable in Auckland.
Wow.
Mostly. Because one planner was telling me the average driveway width is 3.03 or 3.67 metres. Under the new rules, you need 4.4 metres.
So why do they need to be so wide? Is this for all the mobility scooters that we're going to need, or what is it for?
That's just part of the rules. There's accessible parking. So if you provide more than 10 houses, you've got to provide a accessible park. Of course, it doesn't say who owns it. So if you've got 10 houses, rather than provide 10 car parking spaces, you've got to provide 11. And it's pretty easy. I mean, I was with a developer the other day looking at some of his past projects, and he's maximised the rules. And he tells me now that in every development, if he was doing them today, he'd lose a unit.
What?
15, he'd lose a unit because of this rule.
Holy smokes!
Because of that's just the footpath rule. He's not large enough doing the accessible units type of accessible parking. And there's some other bits and pieces which is quite easy. So the government keeps saying more housing, and council keep on changing the rules to make it more difficult. And it's coming to a town near you. It's coming to a town near you unless you all hit it on the head. And one planner was telling me, he goes, there's going to be so much pushback on this. I got a presentation 2 years ago from HUD. They sent it to me. Was it from Auckland Council? Sorry. What do you think about this, Andrew? And I told them all the stuff that I just read in the 200-page report on the weekend. It's all the same stuff. But every developer in Auckland has gone ahead and got a planner and a lawyer to write these big submissions. Probably cost them $10,000 each. And they're all saying the same thing. It's impractical and but this is a good one to moan about, really. This is not moving the country forward.
No, it's not. I mean, well, at least going back to rates, we've got lower rates coming, right? So that's always a bonus for developers. Lower rates hopefully means slightly higher margins. I mean, we borrow a lot of money, right? So lower rate makes a really big difference. If you think about it, you might buy land. By the time you've got your consents and so on, 6 or 12 months could pass by. Your construction. By the time you settle, you're borrowing for 12, 18, 24 months. So if you're paying 9 or 10%, or you're paying 6 or 7%, it's going to make a really big difference. So hopefully that'll encourage a little bit more development. Although I think the bigger effect is going to be on serviceability, on investors coming back into the market, and that's something that reports are saying that investors and home buyers are starting to come back, that's what we need. We need lower rates so that people will start buying off plans, and we can start building more houses again.
Look, the market will ride over all these stupid government and council rules one way or another. But it basically means house prices go up more. And if you don't own the land, you already know the new rules, so you can factor that into your feasibility, and you end up paying less for the land. But it adds costs. But yeah, there's heaps of positives for budding property developers out there. Possibly it's even too late to buy it. Possibly the bottom of the land market's peaked, right? The trough we've been there at the trough, and now it's going up the other side.
I think so. Just on crazy regulations. So this article's about Javier Milei, the Argentinian president. So he has got rid of rent controls. So Argentina was facing huge problems. Obviously, we know they had massive inflation, but they also had huge issues with accommodation supply. And it got to a point where does it say in here? Where some huge percentage of apartments, here we go, by the end of last year, an estimated 1 in 7 homes in Buenos Aires was sitting empty as landlords chose not to rent them out in Argentine pesos. That because the risk was they were being locked into these rents, inflation's going through the roof. If you can't increase your rent, you're losing money, right? Cost of everything is going up. You're paying, your interest costs are going up, your rates, your insurance, your maintenance, everything. I mean, it's going up by the day if you're running at 300 or was it 200% inflation, and you've got rents locked in. So what do landlords do? They don't rent their houses out. They leave them empty. So he got rid of that, and then there was a massive increase in a number of apartments available, and the cost of them dropped. So they said here, after he repealed the rent controls, the amount of rental housing available jumped almost 200%. So, but governments will do it again and again, won't they? I'm just waiting for when New Zealand brings in rent controls. I could just imagine it under a Labour government.
But if you don't think about it, rent controlled means the rent is controlled. But of course, the consequences are dramatic. And New York is the poster child for that stuff. It's just, the development play in New York City is to buy something with lots of rent controlled units, pay them all a fortune to get out of their rent. Their rent was set in 1978 or something. Pay them a fortune to get out and redo the whole building. But anything it's like inclusionary zoning that Queenstown recently voted down. It just, the unintended consequences mean house prices go up. House prices go up because of stupid rules.
Absolutely. Let's have a look at Lightspeed. So we've made we're making good progress on the Property Development Club system. So if you are watching this, you'll see I've just brought up the training center on the screen. So when you come into the website, on the home here, you can go to My Courses, and you won't see the introduction to property development yet. That's still about 2 weeks away. But below it, you will see now group coaching Zoom calls. So you'll be able to play any of our past Wednesday calls. And you'll see 2 Zoom recordings there. So that's pretty exciting. I'm really happy how it's looking. It's progressing really well. The videos are looking great. And we've just ticked over 130 students signed up, so it's going really well. Meeting a lot of really interesting new people. Someone who contacted me yesterday, he'd seen the videos online and seen what we're trying to do, and he was just super excited. He's started developments, done a couple of subdivisions, just about to do a townhouse development, and it's sort of he's doing it all on his own. He hasn't really got anybody to talk to about it. So, that's exactly the type of people we're looking for. We're just hoping they'll find us and we'll be able to help them out, and join the community and everybody can work together a little bit. So yeah, it's going to be cool.
Well, it's looking slick, John. It's looking damn slick. Lightspeed was a good move. The production quality is amazing. And these weekly calls as well. There's so much content that goes into them. your one on financing yesterday, taught me a GST lesson that I'd conveniently forgot for about 10 years. But I'll give you some other antidotes as well, because a few people have been contacting me about the Property Development Club, and one was a consultant, and he said, "Oh, this Property Development Club, I said, yeah, get in there. It's going cheap before the price goes up dramatically." And he was saying, "Well, this is probably a good place to network." I said, "Yes, it will be, certainly in time, and there's plenty of people there now. There's over 100 people, 100 people there at the moment." And he said, "Well, he actually doesn't want to be a property developer. He just wants to learn how property developers think,
Right.
to improve what he does in his service." Which
Yes.
he goes, it's amazing how much us as a consultant in the development industry, talking if I'm him, he doesn't know much about what developers do. And if he can learn how a developer thinks, if he can get into your head, John, then that's good value. So that's a different angle we didn't even really think about. Another angle, I was just speaking to a young lady, and she's a gun, and she wanted me to go through her CV with her, and on paper it's just, why would I hire this person? Once you start talking to her, it's like, well, you've done development projects, you've worked as a project coordinator in Sri Lanka, it's the same stuff over here. Wow,
Right.
okay, we can redo this. And she's joined the Property Development Club.
Okay. Great.
And she just wants to be part of it and learn and constantly go down that route, and certainly at the course. So two different angles that we didn't really even think about. That's
I think it'd be great for councils, for some bank staff. There's all kinds of people who would benefit from getting a really good understanding of what's involved in property development. I think it would open a lot of people's eyes as to how difficult it actually is.
And and learn the lessons before you do them yourself.
Yeah, absolutely. Well, on that difficulty, might be a good time to go into a little bit of mindset stuff. What do you think?
Okay, this is going deep.
Right.
Really,
it's what's that?
My watch swinging in front of my face. Yeah, as you hypnotize me.
Oh, okay. Well, it's mainly for like people that I was talking about before who are actually already in developments and doing it, and at times facing those tough times. And I think it's just a kind of a reminder that property development, it isn't always all just about the completed blocks of townhouses or the the millions of dollars involved. I think it's important to focus on remember that it's actually about all the little things. Property development, it's getting the quotes in. It's about talking to your customers, your buyers, your investors, making sure everyone understands what they're buying, what's involved. It's about building fences. It's about the whole lot's important. It's like when we were writing up the course, I don't know how many times I said, this is key. Oh, you absolutely need this. Oh, this is super important. It was everything. Consenting is key. Design is key. Finance is key. Well, it is. It's actually all important. So you've just got to really stay focused.
I think we have to ban the word critical, right? The word critical had to be banned because it was like every second item.
Yeah, exactly. But it kind of is, because you need all those parts to work together. So you've just got to stay really focused, learn everything you can, and don't complain too much. And I can be guilty of it sometimes. And like you can complain about councils, you complain about interest rates, and you complain about the market. But at the end of the day, I mean, they are what they are, right? So you've got to just focus on what you can control, which is your attitude, really, and think about what can you do better? What do I need to learn? Have I got clear goals? Do I know what my outcome is? And really focus on what you want, not what you don't want, and that's really all I wanted to say on that. It's just, it's pretty basic, but it's also sometimes just a reminder that instead of it's this government and all this type of thing. I mean, the government is what it is. We live in New Zealand, and it's not the easiest place to live right now, but it'll turn around again. So you've just got to stay positive, focus on what you want to do. I mean, there's a lot of opportunity. Just look at this property development club. We've developed it from scratch. there are a whole lot of people coming in and joining. There's a whole lot of really positive stuff going on. And that's in the middle of a economic slump with, all kinds of issues with government and, power prices going through the roof. And you can name problems for as long as you want. But, there are always opportunities. That's what I want to say. If you can set clear goals and you can stay focused, then, there are always opportunities. And just focus on those. If you've got a development underway, maybe you're subdividing a 1 into 2, or you're doing 4 townhouses, just focus on what you're doing. Stay positive, learn what you can, and try and get around other kind of motivated people, because it's really easy, and especially, in New Zealand today, there are a lot of people who want to hold you back. Don't like to see you succeeding because it makes them feel bad. And we've got to try and turn that around. We should be lifting everybody up, celebrating success, celebrating ambition, being positive, being happy for people who are doing well. That's really something we want to encourage. And I know I've said it before, but I'm going to say it again and again and again, because I think it's super important.
Yeah, this is a positive podcast, people. But no, you seriously, this is, and I guess, if we're in a recession or whatever, technical recession, this is when you hone your systems, you do your learning, you stay up late, you work hard. None of this, play hard, work hard. Yeah, play hard, work hard, not, work not very hard. You got to do all the hard yards now, because when the market turns, and she turns real quick, and it could just be on the horizon, if you're not ready, you're going to miss it. So it's actually the best time to get into property development right now. Right?
And when it goes, boy, it goes. I mean, far out. All of a sudden, your projects are sold out. The demand just goes through the roof, and then it turns off. Just stops.
And so join a property development club. You're a little bit interested, and you'll be fired up, and you'll get the techniques and tools to set you on the way.
Yesterday, the group coaching call yesterday was focused on finance. We had a lot of questions in the previous week around finance, so we thought we'd just cut straight to that. We had planned on working through the curriculum, really, but we jumped straight to finance. There's a lot of questions, and actually I have to apologize to anyone who's on the call yesterday. I didn't answer all of the questions, so we'll have more time for questions next week. But I thought let's just work through the development and really talk about what's involved. So we had 46 people on the call yesterday, which was really neat. We talked about different funding sources, traditional banks, second-tier lenders, joint ventures. We talked about the stages of development. Initially your land acquisition and securing finance for that. Then moving on to construction and how that works with staged drawdowns. And we looked at how much deposit, how much equity you need to put into the project, and different ways of financing it. And we talked about bridging or mezzanine loans as well. So if mezzanine really comes in, if something goes wrong, perhaps there are delays in the project, you overrun the budget, and you need to top up. It's not something that you generally have to do, but sometimes if there are unexpected costs. Bridging is more around when you complete the project, you still have property for sale. Now you've got title and code of compliance, and you're trying to sell it. Then you could get bridging finance on that completed stock. We talked about how much return you need to look at. You really need at least 20% return on cost before you get into it. So yeah, I think it was a good session. Still high level. It's a really big area.
Look, I'm just looking at our little agenda here, which we haven't actually told the listeners what it was, but you've got some interesting topics here. Energy crisis and its impact on property developments.
Energy crisis. We could briefly. We've just talked about positivity and energy crisis. I feel like is a bit of a moan, really. Here's an article here. The high cost of our energy crisis. This is from this morning in RNZ. With demand for gas up and supply down, gentailers can't keep up, and New Zealanders are paying the price. So how did we get here? I think it was 2018. We had a different government, and they wanted to protect the environment, and they stopped our oil and gas exploration, and now we're importing it. And this is the thing I just don't get. we're still using the same amount of oil and gas, but somehow it's better if we import it than if we get it out of the ground here. Do you understand that, Andrew? Like, what am I missing?
It's whatever politicians can get away with, right? They say they're not going to carve up the land here, and they don't tell you about the ships from Indonesia full of coal, dug by, I don't know, who knows, slave labor out of Indonesia. Yeah, it's probably not quite right, but, certainly at a different wage rate. Yeah, energy, I don't know what the capital's doing. Haven't really looked at this too much.
Let's just pass
move on
that
to health. Should we move on? So you've got the other one. You must be doing some reading. The healthcare sector and property development.
Oh no, we don't want to talk about that one either. It's too negative. Far too. How about questions? We're getting questions.
John, some questions from our listeners that have emailed us. Well, it's been a couple of weeks since we did this podcast. We've been too busy on the Property Development Club, haven't we?
Yep.
Look, here's a question. I mean, these are fundamental questions. Where do you get your money for? Where do you get money for your first development, and how much do you need?
When you're starting out, it's that initial funding that's the tough part, right? It's possible, but you've really got to go about it the right way. So I would start by getting really clear on your financial position. So how much savings have you got? Have you got any equity in any property that you own? Really get a good sense of how much you can contribute to a deal, whether you're going into a joint venture or you're borrowing from a bank. It's a starting point, right? How much money have you got, basically? So, and then leveraging equity. So that's what I did. So I built a rental portfolio first, and then I leveraged against that. So against my first development, it was actually a large development, one of the largest that I've done to date. And so I leveraged my rentals, my house, my salary, and that was enough to get into the deal. So if you own property, then you can leverage the equity, and like in your home or in your investment property. So a lot of developers do that to get started. What I would say on that though is stop borrowing against your home as soon as you can. Ideally you want to get into a position where you can put your home into a family trust, and if things really go south, you don't want to be moving your family out of their home. And I'm not talking about some unscrupulous developers who do all kinds of weird and wonderful things with multiple companies and all the rest of it. And I'm talking about honest business people who take a risk, and things can go wrong. I think if you have protected your home, I think that's only fair. So bank financings, banks can be a little bit difficult to borrow from, especially low equity and without a track record. They are generally cheaper than a second tier or joint venture. They may not be your first option. Second tier lenders, so they're not as strictly regulated as banks, so it makes them a bit more flexible and often more willing to lend. They don't require as much equity. The downside is that they tend to charge higher fees, higher interest rates, and you have to be a little bit careful because some of them are a little bit unscrupulous. There are the lend to own second tier lenders who really they're only lending you money on your development, wait and hoping that you'll fail and they'll take over your project. So yeah, there can be some risk there as well. Another way is loan to own. Okay, loan to own. That's a good one. Okay, well, it's not a good one. It's a terrible one. They're loan sharks basically. Partnerships and joint ventures would be another one. So it can be a good way to start out. So let's say you've got an auntie who runs a successful business. She's got a heap of cash. She's always busy, but she loves property. She's always talking about property, and you've got time and you've got some skills. You've got a certificate from the Property Development Club. There's no reason why you can't be out there looking for deals. You can find land, you can do due diligence, you can put a feasibility together, and then you can take that to someone like your auntie and say, hey, look, I'll do all the work. I'll put on the sweat equity. I'll make this happen, but you put in the cash, then we'll split it. So that can be a really good way to start.
Well, that leads us into the second question, John. And,
okay.
I mean, you've touched on it. what should I do right now to find a site? Is it the site or the money first?
Well, that can be another good way to start, right? Is property finding, really. So you actually get out there and you look for deals, and then you bring them to people. For example, if you bought me a nice flat level rectangular site in the right zoning, and I could look at it and tell pretty much for certain that, hey, I'm going to be able to put 8 units on this, then that's got value. Now, depending on the price, of course, but then we might do a deal where I say, okay, I'll pay you X amount and I'll take over the contract. And in a scenario like that, you potentially don't have to put any money in, or perhaps a bit of money you might have had to pay for a planner. You might have spent some money on a survey for your due diligence, but you could potentially put in a few $100, $1,000, and make, I don't know, pick a number, 20, 30 grand. I don't know. Depends on the site.
You realise, John, that now you've got 130 odd people in the property development club community who are searching for deals to bring you.
Good.
Good. Yeah, no, fantastic. Look, here's another question for you. Was there anything more on site or money first? Any other options?
Look, it really, if you're starting out, it's crucial to find the right site. Okay, we've just said that you potentially haven't got a lot of equity, you haven't got a lot of experience at this stage. So make it as easy for yourself as possible. Buy land in a location, like let's say you want to do townhouses, you want to do 4 townhouses. We'll look for land where council wants you to build 4 townhouses, and then get something that's flat and level and easy to do. And just make it as easy for yourself as possible.
Should you pay more for that, John? That's always a question, right?
Yes. Yeah, definitely, because it's all about de-risking, really. If you can take unknowns out of the process, then it's a lot more chance of being a successful developer, really. And I mean, that's what your due diligence is about. That's what your detailed feasibility is about. You're assessing, all the suitability of the development, the zoning, the land size, the topography, do you have water, power, what's transport like, any legal constraints, if you got any bats. Oh man, I've got bats again on the site. Well, next door, supposedly. So there's a whole bunch of things that you've got to look into. So yeah, the sites are key. Like I'm gonna say, there you go. The site's the key. I said it's key again. Everything's key. But yeah, it's where you start. Get the best site that you can.
Yeah, I was surprised, really. It's there's 130 people in the TPDC and growing, and it's not just newbie developers or people who want to do it. There's plenty there who are actually doing their own developments, and they're doing some small ones, and they want to scale up and they want to get bigger, and it's quite surprising, and they're there probably for the personal interaction. But that brings us to another viewer's question for one of those people.
Actually, just before you ask me that, one thing that came to my mind about the site selection. If you find a really good site and the right location, and it's it's pretty straightforward and it's flat and it's level and all of those things, what do you think the funding's going to be like on a site like that? Because you've got to remember, you've got to sell this to a bank or a second tier lender or a joint venture partner. So the better, the simpler the site, the easier it's going to be to obtain finance as well.
Yeah, and in relation to your experience on, if your first site's highly complex, this is your first development, then that's a recipe for disaster, really. John, final question here. It's an interesting one, given how you've, made your wealth and done a whole heap of developments. But the question is, how do I scale from my first development to the next?
First of all, scale, just so everyone's clear, scale doesn't mean that you have to go from your first 4-unit development to 14 to 30 to 100, because that's how developers go. Scale could be you do your 4, you go into another 4, and then you start maybe 3 or 4 of those off the plans. Now you buy another site for 4 or 6 or 8, whatever it might be, and as opposed to getting bigger and bigger and bigger, what I did was just do more simultaneous, smaller developments. And it just is a way of controlling your risk. Though, the difference between 4 and 8 isn't that big, depending on the equity that you've got. So you might go from 4 to 8. That's fine. So yeah. So look, to answer the question, how do you scale? Well, you learn, right? You learn from your first project. So at the point that you're moving on to your next one, you've already had a massive learning experience, right? You've completed a development project. And I remember when I must have been towards the end of my first development, and the quantity surveyor, he was a chap probably in his 60s at that time, and he'd seen a lot of developers over the years. And I remember he said to me at one point, "Hey, John, you've broken the back of this." So, what do you mean? He goes, "You've broken the back of development. You can do it again." And that's when it really dawned on me. I was like, "Oh yeah, I know how this works now." I mean, sure, I had still a whole heap to learn, but at that point I'd nearly done my first development. So, and that's a big deal, And when you've done your first, then be really proud. You've pulled something pretty major off that a lot of people haven't done. So take the time to reflect on that. What'd you do well? What didn't you do well? What was hard? What were the challenges? So look at some of the processes. Are there things that you do differently next time? You learn from there's certain things need to be done in a certain order often, or certain things need to be started earlier. So, you can take all of that knowledge from your first project over into your next. Another thing is your network, right? So when you do your first development, you don't know anybody. Well, you might know some contractors, but you haven't got a network of builders and plumbers and surveyors and architects and all these kind of people. Once you've done a development, then you've actually got a team. Then some of the people on the team may have done really, really well, and you enjoy working with them. And others, you might think, well, maybe next time we'll try a different trade. But that's something you really want to keep in mind is your network, strengthening your network, and whether it's contractors, it's financiers, agents, they're all part of it. You can't do it by yourself. You're going to have to deal with these people. Strengthening those connections is something that you're gonna rely on for years to come. I still work with people I've worked for, some of them nearly 20 years. My builder, he helped me out on my first project, and he's still my main builder. So, a solid network means a lot. You can't underestimate it. It helps you open doors, doors to better deals and finance options and reliable partners and things like that. So,
I've worked for a number of developers who've gone down the renovate house, 4-unit, 20-unit. Well, if I'm doing 20, I might as well do 100-unit. Yeah, I'm doing 100, I might as well do high-rise apartments. And that's okay if you don't have to worry about a little 4-letter word, John, for debt, right?
Mm.
and you don't have to if you don't have to worry about debt, then you're in a much better position. But and I know we've said it's you might find it difficult to get finance, but funny enough, there's plenty of money out there for weird, big, massive deals as well. But they only care about their money. They're not too worried about the developer getting out alive. So. Yeah, it's
something definitely to keep in mind.
The scaling question is very interesting.
Well, you should be coming out of your first deal with some money too, right? So, if that first project has gone well, then you've potentially got a couple of $100,000 that you didn't have before. So my advice would just be, maybe for the next couple, instead of leveraging up and doing bigger and bigger, just do the same size again. Only this time, you've got more equity in the project. Right? So you've got less debt, you've got less pressure, you've got less, interest costs. You've probably got a better choice of financiers, because now you're coming along not only with a track record, but with money. You've got more money. So you're a much, much more attractive proposition. So I would, I'd really strongly recommend, if you come out of that first project and things have gone well and you've got some money, and just do the same thing again, or a little bit bigger, and just take time. You've got years and years and years you can do developments till forever, until the end, right? It's not physical. You don't need to be in your 40s or 30s or 20s or whatever it is to be a developer. You can be a developer when you're 80, as long as you're still thinking clearly. So I just don't don't rush it. You'd be much better off doing a few smaller developments for 2 or 3 or 5 years and making good money and learning and building your network and and building a solid base and then leveraging from there. And look, I'm saying this, and I'm an impatient person. I want things to happen. We've got to go, get it done. It's a tricky business. So if you can be in a position where you've got less debt and you've got more knowledge and you've got a good network, it's a pretty good place to be.
Right. Should we do one of your book reviews, John? What's this week's book?
I was thinking about talking about Shoe Dog. I imagine a lot of people would have heard it. It's the story of Phil Knight, founder of Nike or the co-founder of Nike.
He wrote a thesis or something at university. I'm not sure if it was Stanford or something, about a shoe company.
Yes.
Yeah. So he started it all.
Yeah, exactly. And like he came from nothing and built one of the biggest brands in the world. And the book's pretty cool because he doesn't sugarcoat anything. He talks all about the hard work and the risks and the times that he lost and so on. And one thing I really remember from it was the number of times he traveled to Asia and partnered with a new company or tried a new thing. And he was just pushing and pushing and pushing, and he was negotiating and coming up with trying to do better deals, and things didn't work out, and he just carried on, and whether he was finding new suppliers or coming up with new designs or figuring out how to keep paying the bills, he found a workaround for it.
He was at the mercy of Converse, wasn't there? Converse was the juggernaut. And he managed to do a deal with Michael Jordan when Michael Jordan was not yet Michael Jordan, and he hustled that one to death. So yeah.
Well, then it blew up, right? Then it just after that, once Michael Jordan came on board, because what did they do? They something about wasn't the NBA? They all had a certain were they all wearing white shoes or something? And then he got Michael Jordan on with some red.
Yeah, might have been that. I'm not sure if there was a Converse enforced thing or was a color thing, but yeah,
and I remember they had to pay a fine, and they're all sitting around a board table, and it's like, oh well, we can't do that, we've got to pay a fine and whatever. And then someone asked, how much is the fine? And it was like $500 or something, and they're like, God, let's just do it, and we'll just pay the fine every time. It's just really cool.
I mean, that's what I know one developer who said to me, okay, bugger the footpath issue, I'm just going to figure out a solution. Yeah, and no doubt he will.
Yeah.
So
exactly, and that's
everything in development, all right? That's from your bats to the flood to the whatever, the subjectivity on urban design, everything.
Absolutely, it's it's good. So it's well worth a read, and it's an easy read. It's a fun read. It's almost a a novel quite where you can sit down and you can sit by the pool and read it. Like I'm going to Fiji on Sunday, so I'll be sitting by the pool reading books. So.
Are you going to be doing the weekly TBDC call from Fiji?
Yeah, I think it will be. We can't change it. It's 12 o'clock on Wednesdays. Like you can't just turn it off.
What are we talking about on that call? Back to site selection.
What were we going to talk about before we switched over to finance?
Site selection.
It's the
juggle, right? It's the finance or the site selection. We didn't know which one came first, so we jumped into the numbers first. Now we're going into the specifics. Yeah.
And just before we go, please jump onto my Instagram. There we go, at john.kenel. It's been growing very rapidly, which is cool. Thank you for everyone who's following. A lot of people are coming into the club through Instagram. So the more you guys who follow and like and share, the algorithm loves shares, right? It's more than likes. It's more than views. It's all about shares. So if you can share any of my videos or posts with anyone I'd really appreciate it. It makes a really big difference and gets the word out there. So more people chugging away on their developments on their own, and hopefully they'll find the club and come and join. Also, we've got a Facebook page up for the Property Development Club as well. So you can head over there and and we post regular updates on there as well. But yeah, that's probably it from me for today. Thank you very much, everyone, for tuning in. and we'll be back again soon. I think it was quite a big gap this time, wasn't there? What were we, about three weeks, maybe more?
Yeah, well, for the people who just look at this podcast, we haven't done anything for a couple of weeks. But of course, there's been 2 or 3 calls, and they're their own video in-depth podcast training sessions. So
Plus all
we've been busy, yeah.
And all the videos, all the reels, and all of that type of thing. I mean, that's how you do business today. And aside from like people have asked me why I'm doing this, why I'm not just doing developments. Well, there's a few things. One, and I've probably said it before, and if you want to switch off, then now's probably a good time. But one of them is we need more affordable housing, right? And if we have more developers and we can help train more developers, more people to be developers, we're going to get more housing. So that's a big one. I want to be in a country where more people can afford to own their own home. And then the other ones are I really wanted to learn how to create and market a digital product. It's just something I've been interested in. I've always been interested in tech, and I'm interested in that online space. So learning about creating and marketing a digital product, and learning about social media marketing and building your personal brand. So that's something that I'm really working on now as well, is sort of getting myself out there. And it's a massive change, because for 20 years of development, I've been all about under the radar, right? Just stay down there. Don't let anybody know what you're doing. Don't just don't show off. Don't drive a nice car. All these things, especially living in in the Waikato, it's really not appreciated. But now I'm like, what the heck? Let's get out there. I want to learn this, and I think there's an opportunity to help a lot of people, and that's why we priced the course like we have. I mean, we could easily charge $5,000 for the course. There's so much in there, and it's 97 US. It was 47. It's 97. It's shortly going to be 197. The reason it's in US dollars is because we're hosting it out of the US. So the company that's actually helping us build the course and is hosting it, they run courses for Tony Robbins and Grant Cardone and Zig Ziglar's stuff, and lots of the big names. So I wanted a platform that just worked, so we don't have any problems. We have sort of world-class system. So but also I want to try and get US customers and Australian customers as well. So if that surprises you why it's in US dollars, that's why it is. But even at 97, even at 197, it's peanuts. Like, if you're getting into development, you're going to get used to spending a lot of money, right? A lot of money. And you're just paying out, and the value you're going to get from the course is massive. I'm excited. Thank you very much. Thank you, Andrew.
Thank you, John. And echo those sentiments and get into it, people.